Let's talk about how you can begin investing in assets, which apart from individual stocks, will typically be through an investment fund. There are many different types of investment funds, but for now, we'll focus on the main ones open to retail investors like yourself, starting with mutual funds, which are also commonly referred to as unit trusts. The concept of a mutual fund is simple. Picture a big basket, and instead of fruits, this basket holds stocks, bonds, and other investable assets. The basket is managed by professional investors who decide what to buy and sell. When you buy shares in a mutual fund, you're essentially buying a slice of everything that is in that basket. Mutual fund is also a broad term, with many different types of mutual funds, each catering to different types of investors and their various goals, interests, and risk appetites. For instance, some funds are more focused on growth, so they consist of assets such as stocks in companies that have high growth potential. On the other hand, some funds are focused on steady, low-risk returns, so they might consist of fixed income assets, such as bonds. There are also thematic funds that consist of assets which give you exposure to a particular industry or theme. One of the most popular types of mutual funds are index funds. So first, let's clarify, what is an index? An index tracks the performance of stock prices of a specific group of companies. For example, the S&P 500 tracks the performance of the 500 largest publicly traded companies on the US stock exchanges. As the value of the stocks in the S&P 500 goes up, the index rises. And in turn, if the average of stocks in the S&P 500 goes down, the index falls. Index funds replicate the indices that they track. So an S&P 500 index fund will include all of the stocks of the companies in the S&P 500, weighted by their respective market capitalizations. So the larger the company, the larger their weight in the index. For the S&P 500, the top 10 stocks, which includes the likes of Microsoft, Apple, Amazon, Meta, and Google, actually account for more than 30% of the overall index. Like with mutual funds, when you buy shares in an index fund, you own a slice of all the stocks in that fund. And hence, investing in the S&P 500 will give you a large exposure to the companies I just mentioned. Similar to index funds are exchange-traded funds, commonly known as ETFs. Like mutual funds, ETFs can be thought of as a basket of companies. When you buy shares in an ETF, you own a slice of all the companies in that basket. There are also many different types of ETFs, again catering to different investor goals, interests, or risk appetites. The main difference is that ETFs are easily accessible as they are traded on stock exchanges and available on any brokerage. Whereas for mutual funds, they must be bought directly from the fund manager or an intermediary, such as a financial advisor or a digital platform. There are also a number of other differences between ETFs and mutual funds, such as how they are managed and the cost of investing in them. For now, remember that all funds are based on a basic concept of a basket of investable assets, each put together for a different purpose.